Learning Objective 4, Journalize Transactions and Post Journal Entries to the Ledger. Okay, so we're going to record, journalize, and post transactions in the books. The first thing we need to know is a journal. And a journal represents a chronological record of transactions. And when we record into the journal each transaction, there are 3 steps. The first step is we need to specify each account affected by the transaction and classify by type. The second thing we need to do is determine if each account is increased or decreased, and that would mean a debit or credit. And then the third thing we need to do is record the journal. Okay, so a journal is going to look pretty similar to what this spreadsheet visual looks like. We have the journal, we'll have the date, the accounts, and the explanation, and the debit and credit. And the journal is what we call the book of entry. This is where we first record the journal entry. Okay, it's not where we hold balances, it's just recognizing the type of transaction that has occurred and what accounts are impacted and by what dollar amounts and whether they are debits or credits. Rule of thumb is debits always equal credits, and so whatever the journal transaction is going to be, we always have to make sure that the debit and the credit are always equal. Okay. So let's go ahead and look at the transactions for Aladdin Travel and show how we would record those transactions. The first transaction was the company issuing common stock for a total of $50,000. With that, they received $50,000 in cash. We already talked. Cash increased, common stock increased as well. And then later, we've discussed debits and credits. Now that we know which accounts are being impacted, we have to make a determination as to whether it's a debit. Well, cash is increased by $50,000. The rule that we learned earlier, an increase to an asset, cash is an asset, is a debit. And then what we learned for common stock is it's over on equity, it's on the right side. An increase to equity is a credit. So the journal entry will be straightforward. Cash and common stock are increased. The journal transaction will list the date. Cash will go first. Notice that cash is left justified. Debit, we'll list the debit as $50,000, and then common stock is going to be indented because it's a credit. Just proper formatting when we're making journal entries. Common stock, credit, $50,000. So this is the formal way it would be entered into an accounting system. Here is how it looks as it impacts the assets, liabilities, and equities, but the entry itself would be recorded like this. What we looked at in the previous slide is the journal. From the journal, those numbers are then transferred to what we refer to as the ledger. And the ledger is the book of accounts. Every single account that we have has its own ledger, its own balance. Okay? So as an example here, all the ledger, the entire ledger, if you can think of a book, but the book is going to be in the computer. So as an example, cash has its own ledger. And if you can think of it as like a page, cash has its own ledger page, accounts payable has its own ledger page, common stock has its own ledger page. Each account that we have already used and more when we use in the future are going to have their own ledger. So the journal entry that we just created in a journal, these amounts are then transferred to the ledger. So we record the entry here and then we post these amounts to each card. So cash has its own ledger. And by the way, the T accounts that we're using are actually a pretty good representation of the ledger. So we recorded the journal entry here, and then the debit is then transferred to the T account or the ledger. Same here, We have a credit to common stock. Now here, there's no balance here. We don't update any balances, but we take this 50,000 and we transfer it to the ledger and we credit it for 50. So we're keeping track of the balance in the T accounts or on the ledgers. And I do want to remind you that these T accounts really are representations of the ledgers. When we're working on this in an electronic format, it's difficult to actually have a visual of a physical book. And then in the real world, we don't have any physical books anymore. Everything is electronic. But again, every one of these T accounts really is like a representation of a page for each account. So the way the data flows is the transaction occurs, an economic event occurs, the transaction is analyzed, meaning somebody needs to look and look at the source documents, the source, what are the documents showing, whatever receipts, checks, timesheets, whatever it may be, the source documents. And then once they are analyzed, it's when we say analyze, a determination is made of what accounts are impacted and whether they're debits and credits. Once we've made that determination, then the transaction is entered into a journal, into the accounting system. And then those amounts are posted to the ledger accounts. Now, the good news today in the wonderful world of accounting and electronics, everything is done simultaneously. So when you post the transaction to the journal, the ledgers are automatically updated, okay? So just to review, we have a cash $50,000 debit. We've already looked at this. There's no difference. Cash is increased and stock is increased. Common stock, $50,000 credit. So we already saw how this was going to impact the accounting equation. Specifically, the cash account is debited for 50. Common stock is debited for 50,000. So these T accounts are representing the ledger. Transaction 2, $40,000 paid cash. The formal journal entry, the way it's going to be entered into the books. Land debited. It's increased. Remember, the land increased, so that's a debit. It's an asset. It increases. That follows the rules we learned about earlier. We gave up cash. Cash decreased. Cash decreases, therefore it is a credit to cash. We go to the ledger accounts. Cash, debit 50,000. That was the original selling. Cash, credit for 40,000 and debit. So these transactions carry down. Go ahead and show how that might work here. Okay. So journal entry number 1, debit 50,000 and credit 50,000. Put the 1 on this side just so that we have a reference. And we know that these numbers came from transaction number 1. The second transaction, $40,000 decrease to cash, increase to land. Increase to land, decrease to cash. Increase to land is going to be a debit. So the formal journal entry is debit to land, 40,000, and a credit to cash for 40,000. The journal entries are going to look. So land is going to be debited for $40,000, and cash is going to be credited for $40,000. The balance, debit minus your credit, $10,000. So our balance for cash is 10, our balance for land is 40. Purchase supplies for $3,700. So the debit is going to be $3,700 to supplies, that is an asset. And the credit is going to be to $3,700 to accounts payable. Now, before that happened, though, we recorded the journal entry. So first, should back up a bit. First, transaction, we're going to analyze it. In fact, when we did all this up here, we analyzed it. What happened? Supplies was impacted and accounts payable. What happened? Supplies increased and accounts payable increased. Now that we've analyzed it, now we can record the journal entry. The journal entry is going to be a debit to supplies. Supplies is an asset. It increased. It's a debit. Accounts payable increased. Increased is a credit. 37, 37. Debits, credits. So now we go back to the T accounts, to the ledgers. We debit supplies for 3,700 and we credit accounts payable for 37. Accounts payable and supplies. Transaction 4, performs services and receives $7,000 cash. All right, let's analyze it. Let's transaction 4. The analyzation said cash increased by 7,000 and retained earnings increased, but retained earnings is really service revenue. Retained earnings ultimately, but more specifically at this point in time, service revenue. So we're going to go ahead and create an account, a T account. Well, we already have a T account called cash, so let's go ahead and debit the cash, $7,000. So we add our debits and subtract our credits. Our balance after that transaction, this is transaction number 4, is $17,000. And then under the equity section, it's going to be a credit of $7,000. That's entry number 4. Okay, $7,000 debit, $7,000 credit. This is the T accounts and how they impacted. The T account is service revenue number 4. That's exactly what's going on here. I'm putting the references on the outside of the numbers. That's the only difference. Transaction number 5, performs services for a customer on account for $3,000. We need a new account called accounts receivable. And accounts receivable is debited because that's an increase, $3,000. And the credit is to service revenue, $3,000. Now we already have a T account called, so we're just going to put it here, $3,000. This is journal entry number 5. Transaction number 6, we paid cash expenses, rent, utilities, and what was it? I'm sorry, rent, employee salary, and utilities. Okay, we paid it all in cash. Here's the formal. Well, first of all, we analyze what happened. Okay, cash reduced 1,900. No, 2,700. So cash was reduced for $2,700, and these are the expenses. These are the expenses that were paid. Now, retained earnings is decreased. If we want to decrease equity, that, by the way, we're under equity. So if we want to decrease equity, we decrease equity, it's a debit. So all of these transactions are debits, okay? And the formal way when we write journal entries is debits are always written first. So rent expense, debited for $1,100. Salary expense, debited $1,200. Utilities expense, $400 debit. Cash is credited for $2,700. Okay, that is the formal journal entry, and then we have to debit, credit all the related T accounts. Let's do it. So these are transaction number 6. We're going to debit rent expense. We're going to debit salary expense. And we're going to debit utilities expense. So those are the 3 debits. We're going to credit cash, $2,700. We have to update our cash balance here. So if we add our debits, subtract our credits, we should end up with $14,300. Transaction 7 paid $1,900 on the payable created in transaction 3. So the debit, transaction 7. Accounts payable is going to be debited for $1,900. $1,900, and cash is going to be credited for $1,900. We're going to update our balance here. Okay, so we have a debit balance of $12,400. Looking over here, our balance here is a credit balance of $1,800. A credit balance of $1,800. So the ledger for the accounts payable account will show a credit balance of $1,800. No entry for 8. Transaction 9 collected $1,000 from accounts receivable. $1,000 is a debit to cash. We update our balance there. We're going to credit, though, accounts receivable $1,000. So now we can update our balance here. Our accounts receivable balance is $2,000 debit. Transaction 10, $22,000 debit to cash, $22,000 credit to land. I'm going to add $22,000 debit. It's an increase. And then a subtraction of $22,000 to land. And that's a credit. So now our balance in land is now $18,000. Debit, cash, 22, credit, land, 22. That was transaction 10. Okay, so do we get 10 here? Yep, 10 there and 10 there. And then 11, declared a dividend and paid $2,100 to stockholders. So let's create one more account here. This will be the last account we have to create. Dividends. And it looks like that's debited for $2,100. Transaction number 11. And then a credit to cash. Subtracting our credit to reduce our cash. So here are the accounts, and I'm just going to confirm that the balances. Cash account is $33,300. Well, actually what I could do is just look at what we had up here because it's the same thing. We updated the balances here through columns here, but in the ledger accounts, in the ledgers that we use, we keep track of the balance and whether it's a debit or credit. So the balance in cash was $33,300. So we look, making sure it's a debit balance of $33,300. Accounts receivable, $2,000 debit. Let's go to accounts receivable, $2,000 debit. Moving up to supplies, the balance is $3,700 debit. We'll scroll down to the T account, $3,700 debit. Land, the balance at the end of the period was $18,000 debit. We'll scroll down to land, $18,000 debit. Accounts payable, the balance at the end of the transaction was $1,800. That's the balance. Now it's accounts payable, it's on the right side, so that's going to be a credit. So let's scroll down to the T account. And the balance of accounts payable is $1,800 credit. And then we have common stock credit of $50,000. Common stock credit for $50,000, that's the T account. We're going to have a balance of $10,000 into service revenue. I should update this. This is the balance. It is a credit too. So the balance is $10,000 credit. And then we have $1,100, $1,200, and $400 debits for these expenses. $1,100, $1,200, and $400. So let's go down to our expenses. $1,100 debit, $1,200 debit, and $400 debit. And then the last was the utilities transaction, which is the debit to utilities. So all of our balances are updated. We know exactly what we have in each T account. The T account is a representation of the ledger. So we should be pretty good to go. Now, if we wanted to see all of these on one screen, we could take a look here, and I broke it up pretty close to what we have. Cash, 33.3, accounts receivable 2, supplies 3,700, land 18,000, accounts payable 1,800, common stock 50,000, dividends 2,100, service revenue $10,000 credit, rent expense debit of 11, salary expense debit of 1,200, and utilities expense debit of 400. These T accounts represent the ledger.